June 29th, 2010, Tesla goes public at $17 a share. The company has delivered fewer than 1,000 cars in its entire existence. It has never made a quarterly profit. Every major automaker on the planet has declared that electric vehicles are a niche product with no mass market future. And most of Wall Street agrees with them. If you had bought $1 worth of Tesla that morning, one single dollar, and held it without touching it for 16 years, it would be worth approximately $364 today. Based on Tesla's closing price of $411.84 on June 29, 2026, $1,000 would be worth approximately $364,000. $10,000 would be worth approximately $3.6 million. Here's the thing. Almost nobody has that money, not because they didn't hear about Tesla, not because the opportunity was hidden or exclusive or required any special access. Plenty of people bought Tesla stock in 2010. They just didn't keep it. They sold at $25 thinking they had made a smart trade, or at $80 thinking they had been lucky, or at $300 thinking the peak was finally in. They made money every time. They just didn't make the money. And the reason is not that they were wrong about the stock. They were right about the stock. The reason is something else entirely. Let's make the math specific. Tesla's IPO price was $17 per share. The company has since executed 2 stock splits, a 5-for-1 in August 2020 and a 3-for-1 in August 2022. The combined effect of those splits means that one original share from 2010 is now 15 shares. The split-adjusted IPO cost basis is approximately $1.30 per share. As of June 29th, 2026, exactly 16 years from the IPO date, Tesla's closing price is $400.84. That is a split-adjusted return of approximately 364 times the original investment, or, in percentage terms, roughly 36,300%. To compare that against the benchmark, $10,000 invested in the S&P 500 on the same day in 2010 would be worth approximately $57,000 today. That is a strong return by any historical standard. Tesla's $3.6 million on the same $10,000 is a different category of outcome entirely. Not better by 10%. Better by roughly 63 times. Now here is the number that should stop you. That 36,000% return required doing something most investors are physiologically incapable of sustaining. It required watching the stock fall by more than 50%. Not once. Not twice. 5 separate times. Tesla's stock peaked at a split-adjusted price of approximately $4.50 in late 2010, just months after the IPO, and then fell to around $1.40 by mid-2012. That is a 69% collapse on a company that most investors were already skeptical about. The Model S had not shipped yet. The Roadster had sold fewer than 2,500 units total. Tesla's cash position was precarious enough that the company publicly warned it might need to raise additional capital to survive. The Wall Street Journal ran a headline calling it a money-losing startup. Every rational signal pointed toward exit. From a peak of around $20 split adjusted in mid-2015, Tesla fell to roughly $12 by early 2016, a 40% decline. The Model X was running into production delays that Elon Musk would later describe as the most difficult manufacturing challenge in Tesla's history. The company missed delivery targets repeatedly. Analysts who had been bulls started revising their estimates downward. The narrative shifted from revolutionary to execution risk. 40% is not a dip. It is the kind of loss that makes a rational investor question every assumption they made about why they bought the stock in the first place. This one was different. In August 2018, Elon Musk tweeted that he was considering taking Tesla private at $420 per share funding secured and the SEC launched an investigation within days. Musk settled with the SEC, agreed to pay $20 million in fines, and agreed to have his communications pre-approved by Tesla's board. The stock, which had reached a split-adjusted high of around $25, fell to approximately $13 by mid-2019, close to a 50% decline. The company burned through cash at a rate that prompted credible reporting about potential bankruptcy. Consumer Reports pulled a recommended rating from the Model 3. The company that was supposed to transform transportation was being described by mainstream financial media as being an existential crisis. By February 2020, Tesla had become the story of the market. The stock had surged from around $15 split adjusted to over $60 in a matter of months, a movement so violent that it drew comparisons to dot-com era speculation. Then, the COVID-19 pandemic hit global markets, and Tesla fell over 60% in a matter of weeks. From $60 to under $24 in roughly 6 weeks. Investors who had watched their position quadruple and then give back more than half of those gains in 6 weeks, were not experiencing a temporary volatility event. They were experiencing the exact kind of psychological and financial pain that produces selling decisions. Now zoom out entirely. Because Tesla's story of extraordinary returns punctuated by violent crashes is not exceptional. It is the defining structure of almost every generational investment opportunity in American market history. Amazon went from its 1999 peak to its 2001 low in a fall of approximately 94%. A $10,000 position became $600. The company was being compared directly to Pets.com and eToys businesses that were going bankrupt in the same 18-month window. Amazon survived. The investors who held through that 94% drawdown received one of the greatest investment returns ever recorded. The investors who sold, and by Dalbar's data on investor behavior, the vast majority did sell, received a fraction of it. Netflix fell 80% in 2011 after the Quickster disaster, and then another 75% between 2021 and 2022. Apple, in 1997, was so close to bankruptcy that Microsoft invested $150 million simply to keep a primary competitor alive, an investment that was read at the time as charity, not conviction. The stock had fallen more than 80% from its peak. Here is the pattern. Every single one of these legendary returns required surviving a crash that, in the moment, carried credible arguments for permanent impairment, not speculation. Credible, data-backed arguments that the company was finished. The investors who made the extraordinary returns were not the ones who correctly identified that the crash was temporary. Almost nobody can do that with confidence in real time. They were the investors who did not sell. Those are different skills. This is not a character flaw. It is how the human brain responds to financial loss. The field of behavioral finance has spent 40 years documenting what happens when investors experience significant drawdowns. Daniel Kahneman and Amos Tversky's foundational research on loss aversion found that the emotional weight of a loss registers approximately twice as intensely as the equivalent gain. A 76% drop in your Tesla position is not just a number declining on a screen. It is your brain interpreting the situation as danger, activating the same stress response that evolved over thousands of years to protect you from physical threats. Cortisol rises. Attention narrows. The system that keeps you alive is telling you to stop the bleeding. And what makes it worse is that the pain is not abstract. When a $50,000 Tesla position becomes $12,000 during the 2022 crash, you are not just watching a line move down a chart. You are watching the down payment on a house disappear. You are watching years of disciplined saving erased in 14 months. You are watching what could have been your children's college fund cut by 3/4. Converting a temporary price decline into that level of emotional reality is not irrational. It is human. And it is precisely the mechanism that separates the investor who holds and eventually receives $364,000 from the investor who sells and receives whatever fraction the market is offering on the day they exit. Dalbar's annual quantitative analysis of investor behavior has measured this gap for 30 consecutive years. The finding is consistent across every period measured. The average equity fund investor earns meaningfully less per year than the funds they are invested in. Not because the funds perform poorly, but because investors buy after strong performance and sell during declines. The fund did not underperform. The investor underperformed the fund they were in. The gap is entirely behavioral. It is not about intelligence. It is not about information. It is about the collision between a long-term compounding mechanism and a short-term biological survival response. Here is what almost no one says clearly about Tesla's 364 times return from 2010 to 2026. It was not about picking Tesla. Picking Tesla in 2010 was actually the easier part. The stock was being discussed. The thesis that electric vehicles would eventually go mainstream and that Tesla had the technology lead was available to any investor willing to read the IPO prospectus and think independently. Thousands of investors picked Tesla in 2010. The hard part was holding it through a 76% crash in 2022, while every headline in your newsfeed gave you a new reason why selling was the reasonable, responsible, intelligent decision. The hard part was sitting with a $50,000 position that had become $12,000 and not acting on the instinct that every evolved survival mechanism in your brain was generating simultaneously. The investors who made the full 36,000% return are not remarkable for their analytical insight. They are remarkable for one thing: they did not sell. Some of them will tell you it was conviction. Some will tell you it was stubbornness. Some investors who held Tesla through every crash will tell you they almost sold that they came within minutes of clicking the button. The return was waiting on the other side of not pressing it. The skill that generated $364,000 from a $1,000 investment is not stock picking. It is the ability to withstand 5 separate moments, each with legitimate data supporting the worst interpretation of the situation, and choose not to act. That skill is rarer than any analytical framework. And it is worth more. On June 29, 2026, exactly 16 years from the day Tesla went public at $17, the stock closed at $411.84. A $1,000 investment made on that morning in 2010 is worth approximately $364,000 today. The people who received that return held through 5 separate crashes, the largest of which erased more than 75% of the stock's value over 14 months. They held through SEC investigations and production failures and competitor launches, and Elon Musk's Twitter acquisition, and everything else the market used as a reason to price the stock lower. The gap between what Tesla returned and what the average Tesla investor received is not a math problem. The math was always the same. The gap is a psychology problem, the collision between a long-term compounding mechanism and a brain that was never designed to sit calmly through a 76% loss. The question worth sitting with tonight is not whether you can find the next Tesla. They are probably already in your brokerage account or in the index fund you already own. The question is whether, when the next crash comes, and it will come, you can look at a 60 or 70% decline in something you chose deliberately, with the news telling you to sell, with every rational signal pointing toward exit, and do nothing.